unrealized profit on non-current assets, unrealized profit on inventory, cash in transit, goods in transit, intra-group current accounts. Yeah, I think those are the things we looked at. Is there any question for me on that? Hello? Hello?
We can hear you. No question from my end, I guess.
Okay, okay. So just to just to add more to what we did in the last class, I know we did like 1 or 2 illustration on that, but let's look at 2 more illustration before we look at other things. So let's go to question 24. Let's go to question 24. Can someone read for us, please?
Hello. Hello.
Soundman acquired a subsidiary, Electric Limited, on 1st October 2013. The statement of financial position of Soundman and Electric Limited as at 30th September 2014 are as follows. Additional information. The share capital of Electric Limited consists of ordinary shares of Naira each. There have been no changes to the balance of share capital and settlement during the year. No dividends were paid or proposed by Electric Limited during the year. 2. Soundman acquired 3 million shares in Electric Limited on the 1st October 2013. 3. At 1st October 2013, the retained earnings of Electric Limited were 24,700,000. The fair value of the non-current assets of Electric Limited at 30th September 2014 was 27 million. The book value was 33 million. The revaluation has not been recorded in the book of Electric Limited. 5. The director have concluded that goodwill on acquisition on Electric Limited has been impaired during the year. They estimate that the impairment loss amounts to 20% of the goodwill. 6. During the year ended 30th September 2014, Soundman sold inventory of Electric Limited for $50 million. Soundman earned a uniform margin of 40% on these sales. During the year ended 30th September 2014, Electric Limited resold 80% of this inventory. On 30th September 2014, Electric Limited had unpaid invoice totaling $8 million payable to Soundman in respect of these purchases. Required to prepare the consolidated statement of financial position for the Soundman Group as at 30th September 2014.
Okay, thank you very much for that beautiful recitation. So we have Soundman Group, and for Soundman Group, first thing we have to do for every group account question is to draw the group structure. So for Soundman Group, we have Soundman acquiring Electric. Soundman acquiring Electric Limited. And what percentage did they acquire? We were told that that means we have to calculate the interest or percentage of owing. So what percentage does Sanma owes in Electric? We were told that they acquired 3 million shares in Electric Limited. And on the first additional information, we were told that the share capital of Electric Limited consists of ordinary shares of $1 each. So, and looking at this, their share capital is 5,000, but it was quoted in thousands, so that means it is 5 million. So we'll say if they acquired 3 million shares, divided by how many shares does Electric hold? 5 million divided by $1 will give us the number of shares they hold. And if we divide 3 million by the number of shares they hold and multiply it by 100, that will give us the number of shares that was, or the percentage of shares that was acquired. And that is what?
60%.
60%.
60%. So if the percentage of holding is 60%, NCI would then be what? 40%, because NCI is 100. NCI is 100 minus the percentage of holding. So the date of acquisition was what? He said they acquired the shares on 1 October 2013. 1 October 2013. And we are to consolidate as at when? 30th September 2014. 30th September 2014. That is a full year. That is year post-acquisition. Do we have any question?
So please,
Okay.
this 3 million divide 5,000. It's a bit confusing.
Okay. So if you look at the question, they told us that what? They told us that what was their name? Soundman acquired what was it called? Soundman acquired, I'm coming. We were told that Soundman acquired, what was their name? Electric Limited. They acquired 3 million of their shares, 3 million shares in the entity. For us to know what percentage Soundman will have in that entity with that acquisition, we have to say the number of shares they acquire divided by the number of shares the subsidiary actually has. So how many shares does the subsidiary has? They will have what? They have, what is it called? We don't know the number of shares they have, but from their statement of financial position, we can see that what? We can see that they have $5 million in ordinary share capital, but that amount is the monetary value. How then do we know the number of shares that $5 million is? We have to divide it by the nominal value, and they told us in additional information 1 that the nominal value of their share is what? $1 per share. So when we do $5 million divided by $1, it will give us 5 million shares. And if they have acquired 3 million out of the 5 million shares, that then tells us the percentage they have acquired in the share. Is it clear?
Yes.
Is
Thank you.
it clear? You're welcome.
Yes. Thank you very much.
Hello, sir. Sir?
I'm with you.
Hello? Yes, sir.
I'm
Sir,
with
this
you.
question is it from past question, sir?
I really can't tell. This is just compilation of questions. Some of it would have come from past questions, some not.
I know.
Is there any issue?
I'm just joining. That is what I'm asking, sir. So I just want to know where you are.
Oh, you can drop a message for me on your group chat. I will send you the material. Yeah, the materials we shared earlier.
Okay, sir.
Yeah, okay. Then the next thing we go for is having calculated the percentage of holding. We look at other adjustment that we have to do for our consolidation. The retained earnings, we don't need it yet till when we get to calculating the net asset summary. Then we're told that the fair value of the fair value of the non-current asset of electric at the year end were 37 million, but the book value was 33 million. The revaluation has not been recorded. Since the fair value difference was at the end of the year, not at the beginning of the year, if it was at the beginning of the year, we would have so what we'll just do is fair value adjustment, which is a surplus. That's how much. But just to be sure, non-current assets for electric, we have 36,762. I think something is wrong here. The date is wrong because if they told us the fair value of non-current assets as at the year end was 37 million, that's not an issue. But telling us the book value is 33 million, when the statement of financial position on that same date is showing us non-current assets to be 36,762, then that information should have been at the date of acquisition, not at the date of consolidation. That information should have been at the date of acquisition and not at the date of consolidation. So I would permit me to correct that. Though it doesn't mean that if we have fair valuation at the date of consolidation, we cannot treat it. But I will explain to us how we are to treat each and every one of it. I will explain to us. Are we following, please?
Yes, sir.
Yes, sir.
Okay. So what I'm saying is, it is expected that, or let me say, in most cases, the information will be given to us about fair value adjustment is at the date of acquisition, not at the date of consolidation. Reason being that it is at the date we want to acquire the subsidiary, we are concerned with fair valuing the assets and liabilities of the subsidiary. That is to ensure that if the asset has been properly utilized and there is a surplus or gain on proper utilization of the asset, as far as the owners of the business to be the one to enjoy that, since they were the one that maintained the assets properly. And if there has been loss on mismanagement of the asset, it is also the previous owners of the business that will bear that, because they were the ones that mismanaged the asset. But if the business wants to still continue fair valuing the asset or carrying the asset using revaluation model after acquisition, it is permitted. But I'm just saying that the book value they gave us in the question, in the additional information, should have matched what we have in the statement of financial position, since both of them are what? Since both of them are on the same day. But for it to have been different, then it is reasonable for us to say that the date they gave us there was wrong. It should have been the date of acquisition. So we will have fair value surplus. The fair value surplus would be 37 minus 33, and that would give us the asset. So since we are not giving
Please, are you
the useful
writing?
life of
Because I
the
can't.
asset,
We can't see your screen. Oh.
you can't see my screen.
Yes, sir.
Because it's not moving.
We can see the screen, but if you are writing, we can't see what you're writing.
Okay. So note 4, we were told that the directors have concluded that the goodwill on the acquisition of electric has been impaired, and they estimated that to be 20% of goodwill. So we don't know what goodwill will be yet. When we calculate goodwill, we'll be using that information. Then we were told that during the year, Sandbank sold inventory to Electric for 15 million, and Sandman
Please, I
earned
share
a
your screen.
uniform margin of
I can't see your
40% on.
screen. No.
Sir, please, we can't see the screen. Oh.
the
Hello,
sales.
sir. The screen is
At the end of the year,
Mr. Could you
Electric has sold 80% of this inventory. So this will create what?
We can't see the screen. No.
Can you see it now?
No.
No,
Those
sir.
with electrical cannot.
No.
Hello, is it only me? I can't hear anything. No.
You are not the only one. I think he has network challenge.
I'm still trying to fix the screen sharing issue. Please confirm you can see my screen now.
No, sir.
Come back.
Come
Log
back.
out. I've logged out.
No, it's still not showing.
Igloo, MJ náà kì í ṣiṣẹ́ níbí báyìí. Èmi ìsìn ọlọ́run máa ń lo ibi tó ń rìn lọ bí ó tó sán méjì.
Mr. Damola, I think you should log it. Okay. Log out and log in. We can hear you clearly, but we just can't see the screen.
Okay, the screen is back. I think I can see it now.
Can see it now.
God bless
Yeah, I
you.
can see it
We
too.
can see it now.
Okay, let's move on. So for unrealized profit on the inventory, we were told that they had a uniform margin of 40%. So since we were given margin, there will be no need for us to do conversion of markup to margin. We are using the margin automatically. And that will be multiplied by percent of the goods that they sold. 80% of the goods that they bought from their related party has already been resold. So if 80% has already been resold, that means 20% is what will be remaining in their inventory that we'll need to calculate unrealized profit on. And 20% of what? 20% of the 15 million inventory that they purchased. So that will give us how much? That would give us how much?
$1,200.
3 million.
No,
1,000. Any issue? So how do we treat that? Will debit the retained earnings of who is the seller? Just Soundman that sold to Electric, and then will credit consolidated inventory. But having done that, we are told that Electric had unpaid invoices of 8 million payable to Soundman. So that will create what? Intra-group current account. Intra-group current account. And for our intra-group current account, would have what? The 8 million, the group account adjustment is that what? We recognize it. So we'll debit that to the payables account and credit it to where? To the receivables account. Having done that, we can then go to the usual group adjustment, which will start with our net asset summary. Do we all understand up to this point?
No, sir. Please, can you take the fair value adjustment again and the unrealized profits?
The fair value adjustments, we say what? They gave us that the fair value of the non-current asset of Electric Limited at the year end was 37 million, but the book value was 33 million. But they said the revaluation has not been recorded in their books. I then say if that value they are giving us as the book value at the year end is 33 million, if we check their account, we should be seeing 33 million also in their books as their non-current assets. But unfortunately, we are seeing a value that is different from 33 million. So I said that fair valuation of the assets and liabilities for a group account usually occurs at the date of acquisition. The essence of that is the entity that is the two parties involved in the acquisition, that is the buyer and the seller, they want to ensure no one is cheating the other. So at the point of buying the assets, the point of acquiring the company, they will want to fair value their assets and liabilities. That is to ensure that if the assets and liabilities have been properly managed, such that their fair value is higher than the book value, then those that managed it for the fair value to be better, to be higher than the book value, and the previous owner, and they should be the one enjoying that benefit. And if it was poorly managed, that the fair value is now lower than the book value, then those that poorly managed it are the previous owner also, so they should be the one bearing it. So that is the essence of doing valuation at the beginning, at the date of acquisition. But yeah, even though they told us the fair valuation was done at the date of consolidation, the figure we have does not match what we have in the statement of financial position. So I say that might likely be an error on the part of the person that puts the question together. The date should have been 2013, which is date of acquisition. And we calculated the fair valuation surplus to be what? The difference between the fair value and the book value, which is 4,000. And we said the double entry for that would be what? To debit the PPE so that they can increase the asset by the fair valuation surplus and credit revaluation surplus accounts. I now said that if the asset was a depreciable asset, they would have given us the depreciation, the useful life or the depreciation rate or something we can use to depreciate this fair valuation surplus, because it would have affected their depreciation. Remember under IAS 16, we have said that what? When you revalue an asset, you must recalculate the depreciation on it, because the parameters we are using to calculate depreciation would have changed. And in line with IAS 8, when there is a change in an estimate, we have to what? Recalculate what the depreciation charge would be. That's for fair valuation. Do you understand?
Yes.
For the unrealized profit, we are told that what? During the year, Soundman sold inventory to Electric for 15 million. That's their sales price. And Soundman earns a uniform margin of 40% on the sales. Then, at the end of the year, Electric has sold 80% of those inventory. So what does that mean? It means 20% is there to be sold. And whatever profit Soundman has charged on that 20% that is there to be sold will be deemed to be unrealized, because the goods is still within the group. So what do we do? To calculate what profit is attributable to that 20% they are yet to sell to a third party, we say that will be what? the profit on the 15 million multiplied by 20% of it, since it is only 20% that is remaining. And that gave us 1.2 million, which we say will debit it to retained earnings of Soundman so as to reduce the profit they have earlier recognized on the sales. And then we'll credit it to where? We'll credit it to consolidated inventory, because remember, ES2 asks us to measure an item of inventory at lower of cost and net realizable value. But the cost of this inventory to the group is the cost at which Soundman acquired it, not the cost at which Electric acquired it. Because the cost with Electric is acquiring it is not the cost to the group, it's cost to Electric only. Is it clear?
Yes, sir. So the unrealized profits, that's the good that has not been sold, is going to be shared between the parent and the subsidiary.
It's going to be what?
Is it going to be shared between the parent and the subsidiary? Because you did 40%.
No. We are not sharing it. We did 40%. The 40% is different from the 40% of NCIO.
Okay, the 40% is the margin.
Yes, the margin, because that's the profit. You know, margin is the profit we make on sales now, Abby. So that profit, we believe 40% or whatever that 20% is what their profit would have been. That's what we are trying to recognize. Is it clear?
Yes, sir. Thank you.
So then they told us that Electric is still owing Soundman 8 million as a result of the inventory they bought from them. And the group rule is that what? Intra-group owings should be eliminated. So what do? We debit that to payables and credit it to receivables so it can be cancelled from both ends. Is it clear?
Yes, thank you.
Okay. So to do the net asset summary, we'll go for our equity items. Ordinary share capital, we have what? 5 million. For ordinary share capital and share premium, we have said that what? Whatever we have in the statement of financial position is what will be the figure at the date of acquisition and date of consolidation, because they usually tell us that there has been no changes from the date of acquisition to the date of consolidation. So share premium, we have 2 million. 2 million. Okay. Then the next thing will be retained earnings. Retained earnings, what we have in the statement of financial position is at the date of consolidation. So we'll bring that 28,370. Then at the date of acquisition, what we have is what? At the date of acquisition,
24,700.
What we have is 24,700. So if it is 24,700, then our post acquisition, which is DOC minus DOA, would give us what? Figure, please. So the next thing will be, since we are taking all of the equity here, we then check our adjustment. Do we have any equity item there? Yes. Evaluation surplus of Electric is an equity item. So we'll bring it and say fair value adjustment surplus. How much? 4,000 at the date of acquisition. And since it is still existing at the date of consolidation, we will have our post-acquisition earnings to be nil. So aside that, we don't have any other thing because this retained earnings here is affecting that of Soundman. And the net asset summary we are doing is for the subsidiary. So since we don't have any other thing affecting their equity, we calculate what should be the net asset at the date of acquisition and at the date of consolidation. So that will give us what? That's 35.
Date of POC is
Huh?
39.
39.
Date of 39,370.
Okay. So I think with that, we are good to go. We can then move to the next thing, which is calculation of goodwill. So to calculate goodwill, we bring what is our purchase consideration. And purchase consideration would be, that is what they have recognized as investment in Electric Limited. And they said it's 29,000. Then we bring our NCI value. Since they did not tell us anything about NCI, we say we are to measure NCI at what? At proportionate share. And that will be taking the NCI percentage of holding, which is 40%, and multiplying it by the net assets at the date of acquisition, which is 35,700. And that will give us how much?
$14,280.
So we then less fair value of net assets. So fair value of net assets, that is what we have at the date of acquisition, 35,700. So with that, goodwill at acquisition will be what? Goodwill at acquisition will be what?
7,580.
7,580. Then impairment. Don't forget, they told us in additional information. They told us in additional information 5 that impairment should be what? 20% of goodwill. So we'll say impairment 20% of 7,580. That will give us what?
1,516.
1516. So with that, goodwill at consolidation would be what?
6,064.
6,064. Okay. So having done goodwill, the next thing will be to do what? To do NCI. And to calculate NCI, we'll start with what? Our value at acquisition. Value at acquisition. Value at acquisition, which you can just pick from our goodwill calculation, that is 14,280. Then we'll do share of post-acquisition earnings. The post-acquisition earnings, NCI will take 40% out of it, and that is how much? 3,670. That's how much?
1,468.
1,468. Aside that, there is nothing else to give NCI, so we'll close that there with how much? And calculate consolidated retained earnings.
15,748.
15,748. So for consolidated retained earnings, we would have what? So in our consolidated retained earnings, we'll bring Soundman's retained earnings. And Soundman retained earnings is what? 34 to
64. Okay, 32 to 34 to 5.
Ugo, is that you? Who is that person? Ugo, right?
It's me, yes.
You need to take more of what's it called? Onions. Cutting onions so that you cry very well, so that you can be seen clearly. Or you can ask for some breakfast. Anything that shall make you cry so that you can be seen clearly. So after Sandman's retained earnings, we then bring their share of the post-acquisition earnings. And what's their share of post-acquisition earnings?
60% of
share of post-acquisition earnings. That's 60% of 3,670. Then impairment, because they will be the only one bearing the impairment, since NCI is measured at what? At proportionate share. This is when NCI is measured at fair value. Both parent and NCI will share impairment. So after impairment, what else do we have? We look to our calculation. Do we have any adjustments? Yes. The unrealized profit of 1,002. So we say unrealized profits on inventory.
Sorry, sir, if I got it clearly, you said that when impairments is at, I mean, when there's full good, what's it called? Full fair value, that's when the impairment is shared between the parent and the subsidiary. Is that what you said?
Yes, if NCI is measured as proportionate share, you will not share impairment. But if it is measured at fair value, then you measure what is it called? If NCI is measured as fair value, then they will have to share impairment, because at fair value they are contributing to the goodwill, so they will also share part of the resulting expenses. Is it clear?
Yes. The share of post-acquisition earnings is 2,202.
2,202. So please give me the summation so that we can quickly consolidate.
$33,711.
33,711. Okay, having done that, we can then consolidate. So we'll have consolidated. Please, if you have any question, don't hesitate to ask. Statement of financial position. I got 30 September 2014. So would have what? We'll have
Yes, only direct because hey, you more bill. Hey, I'm going to tell you now for hey, this too. Mo fẹ́ ṣe bí ṣe this too. Okay.
So we have non-current assets. We'll have PPE. That will be 53,181 plus 36,762 plus the non-current as the fair value adjustment of 4,000 that we say we should debit to PPE here. And aside that, I don't think we have any other thing. So what do we have as the summation of this? Then we have what? Goodwill. Goodwill. What's goodwill? Let me skip.
Okay, 6,064.
6064. The next one is what? Current assets. For our current assets, we will have what? 28,484 plus 10,337. Then we look out for what adjustment do we have to current asset. Now, because they group the current asset together, it means any adjustment I have here that is affecting current assets will have to go there. So I say I'm crediting inventory here. Inventory is a current asset. So a credit to current asset will be negative. So I'll say minus 1,002. Then here I say I'm crediting receivables. Receivable is also a current asset. So I'll say minus 8,000. And that will give us how much?
The PPE is 93,943.
943. Okay.
Current assets is 29,621.
29,621. So what will be our total assets? For our equity and liabilities, we'll have ordinary share capital. Please don't forget, we don't consolidate equity. 20,000. Share premium.
The total is 129,628.
10,000. 129.
628.
Okay, then we have retained earnings. But here, instead of ordinary retained earnings, what we'll be bringing is consolidated retained earnings. So for our consolidated retained earnings, we'll have what? We have 33,711. So our shareholders fund will be what? 63,711. Then we'll bring the non-controlling interest. Non-controlling interest, which we calculated to be 15,748. Then we bring our liabilities. We have non-current liabilities, which is what? 35,000 plus 8,000. No adjustment to that. So that will be what? 43,000. Then current liabilities, we have 11,440 plus 3,729 minus what? Remember we said we have to credit payables. Yeah, we have to debit payables. Okay, and debit with credit balance account will be negative. So we'll have 6,000. So give us how much?
$7,129.
$7,169. Summation
129.
129.
Yes.
129 what?
I said 7,129.
129 or 169.
Talking about the current liability.
Liabilities. Yes. This is 11,440 plus 3,729 minus 8,000. It should be 7,169, please. Check it again.
Still 7,129, I'm getting.
11,440 plus 3,729 minus 8,000.
Oh,
Yes, you are correct.
sorry.
It's 71669. Sorry.
Because there was a time I was also going to school, you know.
Okay, yeah, that's correct. 12962.
Okay, thank you. So that is that. Any question on this before I proceed to the next question?
Okay, sorry, sir. I think earlier on we were talking about equity before we get to equity and liability.
Please don't use your bedroom voice, please. I know you are in the bedroom, but don't use bedroom voice. Use the one I
Okay,
can hear, please.
excuse me, sir. I said earlier before getting to equity and liabilities, I thought
Yes.
we worked equity up somewhere there. So I felt maybe like what I know, like if there's other component of equity, it should be under equities and liabilities.
I don't think I quite follow. You said I wrote equity somewhere, and I did not really get the question. Can you take it again, please?
Like if you can take the straw up, there's a place we
Okay.
calculated equity.
Okay.
Yes, so I felt won't it be recorded under the equity and liabilities for other components? Since
You mean this net asset summary?
yes,
We've already used it. You know the date of acquisition figure. We've used it in calculating goodwill. The post-acquisition earnings figure, we've already shared it also to calculating NCI and consolidated retained earnings. We bring it again, that will be double counting. That's why we
yes,
don't consolidate equity, because everything in their equity has already been used in calculating other things.
all
Do
right,
you
sir.
understand?
Yes, sir.
Yeah. So while we are the absence of other questions, but if you have, still please go ahead and ask me. Let's look at question 25. After which we will then look at mid-year acquisition, and we might call it a time for tonight. Then in our next class, before our next class, I will encourage everyone to go through what we have discussed from inception of the class till tonight, so that in our next class, when we'll be looking at in our next class, we'll be looking at consolidation of SOPL, after which we will then look at a question that combines consolidation of SOPL with SOFE, and that might actually touch everything we have discussed so far on group accounts. But mind you, we are gradually getting to, we are already at the middle of group accounts. So if we have not started reading, let's start this. By the end of today's class now, you should be able to consolidate anything that has to do with consolidation of SOFP. The only thing you may not be able to do now is consolidation of SOPL, which by God's grace, next week we will do it and conclude on that. So can someone read this next question for us? Question 20. 25. Yeah, question 25.
You are provided with the following statement of financial position for Shark and Minnow. All figure being equal and corrected, the following information is available. Shark purchased 7% of the issued ordinary share capital of Minnow 4 years ago, when the retained earnings of Minnow were 20,000. There has been no impairment of goodwill. 2. For the purpose of the acquisition, plant in Minnow with a book value of 50,000 naira was revalued to its fair value of 60,000 naira. The revaluation was not recorded in the accounts of Minnow. Depreciation is charged at 20% using the straight line method. 3. Shark sells goods to Minnow at a markup of 25% at 31st December 2000X. The inventories of Minnow included 45,000 of goods purchased from Shark. Minnow owns Shark 35,000 for goods purchased, and Shark owns Minnow 15,000 naira. It is the group policy to value the non-controlling shareholders at fair value. The market price of the shares of Minnow just before the acquisition was 1.50. Required: prepare the consolidated statement of financial position of Shark as at 31st December 2020X0.
You done?
Yes, I am done now.
Okay. So we have information about Shark and Minnow, and just quickly go about it our usual way. We have Shark Group, so in the Shark Group we have Shark acquiring Minnow and they said they acquired 70%. So we don't need to bother ourselves calculating percentage of holding here. 70%, and CI will be 30%. Date of acquisition was what? They said 4 years ago. And when are we consolidating? We are consolidating as at 31 October 20X0. October 20X0. So we can see acquisition occurred 31 October 20W7. So the so the next thing we have is what? We are told that plant in Mino with a book value of 50 million was revalued to its fair value of 60 million for the purpose of acquisition. So that gives us what? A fair value adjustment surplus at the date of acquisition. Fair value adjustment surplus. So that's 60,000 minus 50,000. That would be 10,000. And what do? We debit that to PPE and we credit it to where? Revaluation surplus of who? Of Mino. Then we were told that what? The revaluation has not been recorded. Okay?
Hello, sir.
The
Please, I
depreciation
want
is
to ask a
charged.
question. Can you hear me?
I'll take your question. Can I finish this?
Okay.
We're told that depreciation is charged at 20% using straight line method. So because they have not captured this revaluation surplus, it means they would have still been depreciating the asset at its book value. So now that we are recording the evaluation surplus, we'll also record the depreciation that should arise on the evaluation surplus. So we call that under depreciation, and that will be the evaluation surplus multiplied by what? The depreciation rate. The depreciation rate, they say, is 20%. So we say multiply by 20%. However, this has been going on for the past 4 years. Of acquisition to date of consolidation is 4 years. So, and since this revaluation was done since date of acquisition, we calculate 4-year depreciation, and that will give us how much? That will give us 8,000. And the double entry for that will be to debit what? Retained earnings of Mino and credit what? Credit PPE. Credit PPE. So your question, please.
Hello, sir.
I can hear you.
Please, first of all, this date of acquisition, why is it 2007? Because
it's not 2007, no. I said 20W7. We don't know the year precisely. When they use X in the question, it's because they don't want to state the specific year. So if it is 20X0, I just calculated that 4 years backward would have been 20W7. So 20W7, 20W8, 20W.
It's not a full year now. It started from October.
9, 20. What am I saying? Yes. 20W7, October 20W7 to October 20W8 will be 1 year. To October 20W9 will be 2 years. To October 20X0, sorry, it should be 20W6 then. But in order to avoid this, I could have just written 4 years ago there as at the date of acquisition. I can just say 4 years ago since they did not give me the specific date. Is it clear?
Yes, please. Also, can you recap on this fair value adjustment?
Unfortunately, I'm not wearing any cap, so there is nothing to recap.
Please.
Additional information too. They said for the purpose of acquisition, A plant in Mino that has a book value of 50,000 was revalued to its fair value of 60,000, but the evaluation was not recorded in the account of Mino. Meanwhile, depreciation is charged using straight line method of 20%. So what are we saying? If the plant was revalued on the date of acquisition, then we have to capture the fair valuation surplus in our books, which is 60,000 minus 50,000, and that will give us 10,000. We are doing this because they ought to have done it, but they did not do it. Then, because they said that asset is being depreciated at 20% per annum, we understand that since it is only the book value they were carrying in their books, it is the book value they would have depreciated over the last 4 years, whereas they should have depreciated the revalued amount. So the difference between the book value and the revalued amount, which is the revaluation surplus we just calculated, is what is left to be depreciated. That is what we now depreciate using the same 20% over the last 4 years. Is it clear?
Yes.
Huh?
Yes.
Any other question?
Sir, I want to ask, is it possible that we will calculate over depreciation?
Is it what do you say again?
Is it possible to calculate over depreciation since this one is under depreciation?
Yeah, sure. We will have over depreciation if the fair value adjustment is a deficit. Because if it is a deficit, it means we would have been depreciating the asset at a figure higher than the value of the asset itself. So we'll use over depreciation to correct that.
Okay, sir. Thank you, sir.
Is it clear?
Yes, sir. Thank you, sir.
Okay, so the next thing is what? They sell Shark sells goods to Mino at a markup of 25%. At the end of the year, the inventories of Mino include 45,000 of goods they purchased from Shark. So what do? That has created unrealized profit on inventory. That would be what? Since they gave us markup, we first need to convert markup to margin. So that will be 25 over 125. Multiply by what? Multiply by the inventory figure, 45 million. 45,000. So that will give us how much?
9,000.
9,000. So 9,000 would debit that to where? Would debit that to retained earnings of the seller, which is Shark. And we can credit that so we credit that to inventory. The next we have is what? They said Mino owes Shark 35,000 for goods purchased, and Shark owes Mino 15,000. So those are intra-group current accounts. So what do we do to it? Let's say intra-group current accounts.
I want to ask something, sir.
I can hear you.
So this unrealized profit, Shark acquired Mino and Shark is selling to Mino. So the unrealized profit is still in the books of in the warehouse of Shark. What about if it's with Mino? Is it same treatment?
Okay. I'm not sure I really get your question very well. But if I'm to say what I understand from what you asked, is that if the goods are mixed up, Abi, and they are not from the same vendor.
No, no. What I'm asking is, Shark is selling to Mino. That means
Okay, can you
the
rephrase your question, please?
Shark is selling to Mino. The goods is still with Shark. So Mino bought it from Shark. What about if goods is with Mino? If Mino is selling to Shark, it's Shark that acquire Mino. What about if Mino has the goods in his custody and Shark is buying from Mino? Is this same treatment?
Selling the so far the sales is between the group and it is yet to be sold to a third party. We have to calculate unrealized profit. The only thing that will change is that the retained earnings that will be affected will now be that of the subsidiary, not that of the parent, because it's the subsidiary that gave it.
Okay, sir.
Is it clear? So for the intra-group current account, what they hold, what Mino owes Shark, 35,000, would debit that to payables accounts and credit it to receivables accounts. Then what Shark owes Mino, 15,000, would you recognize that too? So we debit what? We debit payables also, and we credit receivables. Having done that, we were told that what? The group policy is to value NCI at fair value. Even if they did not tell us that, the fact that the next additional information gave us the market share of the subsidiary before acquisition already knows they want us to measure NCI at fair value.
Please,
So
I
we
have
can
a
just say
question.
NCI at fair value would be, since they said the value of the shares is 150 crore, we then put 40,000 divided by 1 naira. That would give us what?
Please, I have a question.
So
I have a question. Please, can I go ahead?
go on.
Okay. Number 3 is on the inventory. How do
Can you
you
hear
get the
me?
125? Yes, I can hear you. You
Hello?
wrote 25. Is it me? Hello, can you hear me?
I can't tell
500.
you if you can hear me.
Oh, I can hear you. Can you hear me now? Hello, can you hear me now? Is it from my side? Can you hear me now?
I can hear. Goodwill, are you not hearing now? I can hear.
Oh, Mr. Godwin, are you? I say Godwin. Sorry, Goodwill. Please, can you hear me?
He cannot hear you. I think the thing is,
I think he's having network issue.
yes. What's in that side?
Hi.
Hello, please. It seems Mr. Goodwill is not online. It seems he's having network issue.
I think so. Yeah, he has logged out.
Hello, class. Is the class in progress? He will be back in. He will be back in some minutes, please. He will be back in some minutes. He's trying to
Thank,
reconnect back to us. He'll be back in some minutes. Just give him some minutes.
thank you very much. Yeah.
Hello, hello. Please confirm you can hear me.
Okay. Yeah, you sir.
We can hear you, sir.
Yeah. So are we all clear up to this point? Can I continue?
No, please. Oh, I was actually asking a question before you got locked out.
What's the question?
Can you hear me now? Okay, number 3, the inventory. You wrote 25 over 1.5. How exactly did you get the 1.5?
1.5K.
Sorry, not 1.5, 125.
Yeah, 25 over 125 was as a result of converting markup to margin. You know, we say when we have markup is where profit is expressed as a percentage of cost, while margin is where profit is expressed as a percentage of sales. Now, when we have markup, it simply means that what? The profit is expressed as a percentage of cost, but the value will be what? Kí ló ń ṣe bẹ́ẹ̀ tó ń ṣe bálabàla báyìí? Stress mi jàre.
I can't hear you, sir.
So, as I was saying, the so well, if you look at the information we have here, we were given that included in the inventories of Mino was 45,000 of goods that were purchased from Shark. Mino would have recorded those goods at the price which is selling price to Shark. So if the price were selling price to Shark to determine the profit element, on it, what we should apply on selling price is margin, not markup. And to convert markup to margin, it will be what? Profit markup, which they gave us initially was profit over cost. But when we now add profit to that cost we have as the denominator, it becomes profit over sales, which is margin. So instead of we having 25 over 100, which is markup, we then add the 25 to the denominator of 100. That makes it 25 over 125, which is now a margin. Is it clear?
Yes, very clear. Thank you.
All right. Can we proceed then?
Yes,
Can we
please.
proceed?
Yes, please.
Bravo. See, so and then see
So we cannot see your screen.
yeah.
Sir Goodwill, we cannot hear you. Talk less not of seeing your screen.
time.
Those are the things that.
Hello, I'm very sorry about the network wahala. Very sorry about the network wahala, but please confirm you can hear and see my screen now.
Yes, I can hear and see your screen.
Okay, for goodwill calculation, we would have what? Purchase consideration. The purchase consideration is how much? 200, as we have it here, 200. Then NCI at fair value, which we calculated earlier, we calculated it to be 76,500. That will be 76.5. We then less fair value of net assets. So fair value of net assets is how much? 200. So that will make goodwill to be what? 76.5. Since they told us that there has been no impairment of goodwill, so if there has been no impairment, goodwill will still remain at 76.5. Then we can then look at what is our NCI. NCI will be what? Value at acquisition. So the value at acquisition will be what? 76.5. Then their share of post-acquisition earnings will be what? They hold 30% of 22. We take 30% of the 22, and that will give us how much? That would give us 6.6. And since there is no impairment, that means nothing else is coming here. And that will be what? 83.1. Then our consolidated retained earnings will have what? Sharks retained earnings. Sharks retained earnings will be what? 215. Then share of post-acquisition earnings would be what? 70% of 22. And that will be what?
15.3.
0.4. So what else do we have? We'll start looking out for the adjustment we have. Unrealized profit of 9,000. I think that's the only thing we have. Unrealized profits on inventory, 9,000. Then aside that, we don't have any other thing affecting this. So we'll have how much? That will be 221.4. So we can then consolidate. So in our consolidated statement of financial position, as at 31 October 20x0, we'll have non-current assets, plants. That is 325 plus 70. That will be 495. Fixtures, we have what? 200 plus 50. So, it is the plan that was revalued. Oh. Sorry, since it was the plan that was revalued, thought it was fixtures.
Please, that one is 395.
So we have plus 10, which is the revaluation surplus, minus 8, which is the under depreciation. 395. So it should be 397. Then this will be 250. Then instead of investment in Mino, we'll bring goodwill. Goodwill, which is what? 76.5. And then our current assets, we have inventory. Inventory, which is what? 220 plus 70 minus the 9,000 of unrealized profits. So what do we have? Receivables. That should be 145 plus 105 minus what? So there be credit it with 35,000 and 15,000. So we'll say minus 35 minus 15. Then bank. 100. I don't think we have any adjustment to do on that. So that will be 100. So please give me figures so we can get the total assets.
The inventory is 281.
281.
The other one is 200.
200. So for our equity and liabilities, we will have our ordinary shares to be 700. Consolidated retained earnings. Consolidated retained earnings, we have 221.4. So that will be 921.4. Then non-controlling interest, we have how much? 83.1. Any issue? Current liabilities. Current liabilities, we have payables, 275 plus 55. We'll be deducting 35 and 15, which is into our group current account we want to derecognize. So this will give us 280. Then bank overdrafts, 20. Figure, please. Figure.
Yes, it's correct. The other one too is the same thing.
So that is that. Any question? Any question? In the absence of question, the last thing on our discussion list for tonight is media acquisition. If you look at all of the illustrations we've been doing so far, the acquisition will either occur on the last day of the business or on the first day of the business. But in some cases, acquisition might occur in the middle of the year. And when acquisition occurs in the middle of the year, our major challenge would be on determining what the retained earnings should be at the date of acquisition. For the ones we've been doing, they've always been giving us retained earnings at the date of acquisition. That's because it will be readily available in the account if it is at the beginning of the year or end of the year. But when it is middle of the year, we will be asked to have to calculate what the retained earnings at the date of acquisition is ourselves. And how do we calculate it? To calculate retained earnings at date of acquisition, we will either do retained earnings at date of consolidation minus post-acquisition earnings, or we do retained earnings at beginning of the year plus earnings before acquisition. But the first one is the most easiest one to do. So in order to understand that or put that into practice, let's quickly do question 26. And now once we are able to do that, we can call it a time for tonight's class.
On May 1st, 2007, Kai bought 60% of Susanna, paying $76,000. The summarized statement of financial position for the two companies are, as at 30 November 2007, are all figures being correct. The following information is relevant. The inventory of Susan includes $8,000 of goods purchased from Kai at cost plus 25%. On 1st June 2007, Susan transferred an item of plant to Kai for $15,000. Its carrying amount at that date was $10,000. The asset had a remaining useful economic life of 5 years. The Kai Group values the non-controlling interest using the fair value method at the date of acquisition. The fair value of the 40% non-controlling interest was $50,000. An impairment loss of $1,000 is to be charged against the goodwill as the year ended. Susan earned a profit of $9,000 in the year ended 30 November 2007. The loan notes in Susan's book represent monies borrowed from Kai during the year.
Just pay me for some minutes.
Okay. All the loan note interest has been accounted for. Included in Kai's receivables is $4,000 relating to inventory sold to Susan during the year. Susan raised a check for $2,500 and sent to Kai on 29 November 2007. Kai did not receive this check until 4th December 2007. Required, prepare this consolidated statement of financial position as at 30 November 2007. I am done reading now. I'm done with the reading.
Okay, thank you very much. So let's just quickly do this so that we can all retire for today and get back to work tomorrow. So we have the car group. So we have Carl, which acquired Susan. 60%. NCI is 40%. Date of acquisition and date of consolidation is what? The acquisition occurred on May 1, 2007, while we are consolidating on November 30, 2007. So if you look at this now, the post-acquisition period is how many months? I think this is 6 months, right?
6 months, sir.
Is it 6 months?
Yeah, 6. May, June, July, August.
7
months.
months.
7 months.
7 months. So please, let's be careful. If need be, count with your fingers, please. So having done that, we go to the next thing. They said the inventory of Susan includes 8,000 of goods purchased from Carl at cost plus 25%. That means we have unrealized profit on inventory. And that will be what? 25 over 125. Because if it is cost plus, that means it is, what is it called? That means it is
markup.
So what do? It will be 25 over 125 times 8,000. That will give us what?
Answer 6.
1,600. We debit that to what? Retained earnings of who is selling. If Susan is the one keeping the inventory, that means Carl would have been the one selling. And we credit inventory. We credit inventory. The next we have is what? We're told that on 1 June, Susan transferred an item of plant to Carl for 15,000, while its carrying amount on that date was 10,000. So that creates what? An unrealized profit on non-current assets because they sold at a value higher than its carrying amount. So what do? We recognize that also. How much? 5,000. We debit retained earnings of who? Susan, which is the seller, and credit what? We credit PPE. But then they said the asset had an economic life of what? 5 years. Carl that has purchased the asset will be depreciating at 15,000 instead of them to be depreciating for the group at 10,000. So we'll have to calculate what? Over depreciation. And the over depreciation will be the profit, which is 5,000 divided by the 5 years. So, but when did they buy the assets? On 1 June? 1 June 2007 to the date of consolidation, which is November 30, 2007, is 6 months. So we'll say multiply by 6 divided by 12, because it's 6 month depreciation they would have charged. So the same thing, we are only taking what? 6 months over depreciation. So that will be what? 500. And how do we treat that? We'll debit that back to our PPE and we'll credit it to the retained earnings of CAL. Are we getting it, please?
Yes,
Are we
sir.
getting it?
Yes, sir.
Then the next will be what? They said the non-controlling interest is fair valued. No problem. Impairment loss, no problem. Susan earned a profit of 9,000 for the year. Why are they telling us that? Because we need to calculate retained earnings at the date of acquisition. So to calculate retained earnings at date of acquisition, we will say what? The retained earnings at the end of the year is 69,000. 69,000 will then take out the post-acquisition earnings. If they made 9,000 for the year, throughout the year, and we have acquired them over 7 months, if we multiply this by 7 over 12, because we assume that they make the same profit over the years. So by the time I multiply 9,000 by 7 over 12, it gives me what they made after acquisition. So once I deduct what they made after acquisition from the entire retained earnings, it gives me what they would have had before the acquisition. Is it clear? Is it clear?
Sir. Yes, sir.
So figure, please.
5,250 for the 7 over 12 times 9,000.
That is 63,750.
So 63,750.
Maybe to buy my mobile later. Sorry. 63,750. So the next thing will be what? They said the loan notes in Susan books represent monies borrowed from CAL during the year. All the loan on interest has been accounted for. So this 20,000 we have in Susan books is loan borrowed from CAL. CAL would have recorded same as what? As part of their investment. That's why you notice that, you see, you have to be paying attention to details in question. Before, in the previous questions we have been doing, you'll be seeing something like investment in subsidiaries, investment in the name of the subsidiary. But here, they just put investment. That's to tell you that what we have here is not only the purchase consideration. So, but that is an intra-group loan. The same way with the recognized intra-group current account, with the recognized intra-group loan. So we'll say the 20,000 will debit it to where? To the 8% loan notes account and credit it to where? The investment account. Because for CAL is an investment. It is only because it is the group accounts we are recognizing it. So then we move to the next thing. Do we understand, please? Do we understand, please?
Yes, sir.
Okay. The next thing is what? We're told that included in CAL's receivables is 4,000 relating to inventory sold to Susan during the year. Susan raised the check for 2.5 and sent it to CAL on November 29. But CAL did not receive the check until 4 December. So what do we do? When we have information like this, the 2.5, CAL is recognizing a receivable of 4,000. But Susan has already raised check for 2.5. So we'll first deal with that check. We call it what? Cash in transit, and we say for the purpose of consolidation, we'll assume they've received the money. So we'll debit the bank account and credit CAL's receivables. Then the intra-group balance, intra-group current account balance would have now changed. What will it change to? Of the 4,000 they said they were owing them before, we have said they have received 2,500. So what they will be owing them now should be 1,500. And this is what we tie with Susan's record. Because when Susan raised the check for the 2,500, Susan would have reduced their home payable to CAL by that 2,500. So the 1,500 would recognize it also by debiting payables and crediting what? Receivables. Is it clear? Is it clear?
No, sir, please recap.
They said included in CAL's receivable is 4,000 relating to inventory they sold to Susan during the year. So that means CAL is having a 4,000 receivable in their book that they are expecting from Susan. But they said Susan has already raised the check of 2,500 that they sent to CAL, even though CAL did not receive it till the date of consolidation. So if Susan has raised that check, we have said that that check Susan has raised is to be treated as cash in transit. So for the purpose of consolidation, we'll assume they've received the money. So that we debit it to bank and credit it to their receivables. Now, if they have received the money, that means what Susan is owing them will no longer be 4,000. Rather, it will be 4,000 minus that 2,500 we said they have now received. So that leaves us with 1,500 outstanding between both of them, which will now be writing off as intra-group current account. Is that clear? Is that clear?
Yes, thank you.
Yes, sir.
So the next thing will now be for us to do our net assets summary. So in our net asset summary, we will have the DOA, the DOC, and the PAE. We have what? Share capital, which is 40,000. We have said it will be the same on the date of acquisition and date of consolidation, except otherwise stated. Retained earnings at the date of acquisition, at the date of consolidation, it is 69,000. Date of acquisition, we calculated it to be 63,750. So post-acquisition earnings will be what? Then I will start checking my adjustments. Adjustment we say debit retained earnings of Susan here. So I'll say unrealized profit on non-current assets. It happened on the date of consolidation, not at the date of acquisition. So that's how much? 5,000. Because if we are debiting retained earnings, it means a negative value. Then I think that's the only thing that is affecting their books. So what do we have? This will be 103,750. Figure. Hello.
This one is 104.
104.
That one is 104.
So if it is 104, that means the post-acquisition earnings is 250.
Yes, that one is 5,250 up.
Are you sure it's 104? Okay. 5,250. So post-acquisition earnings should just be 250. Am I right?
Yes, sir.
So if that is that, we can then move to calculation of goodwill. Goodwill calculation will then be purchase consideration So our purchase consideration will be what? They told us they acquire 60% in Susan for how much? For 76,000. For 76,000. So say 76,000. Then NCI, we've been told that NCI should be measured at fair value. And they gave us the fair value here to be what? 50,000. So we less fair value of net assets. Fair value of net assets is what? 103,750. And that will give us how much goodwill at the date of acquisition.
$22,250.
22,250. Then we less impairment. They said there is impairment of 1,000. So impairment of 1,000 will be what? 21,250. So that's goodwill at consolidation. And note 9, NCI. NCI will be what? Value at acquisition. Value at acquisition is what? 50,000. Then share of post-acquisition earnings is what? They will share 40%, Abi? They will share 40% of what? Of 250. And that should be 100. Then share of impairment. 40% of what? Of the 1,000. So 40% of the 1,000 would be what? 400.
100.
So having done that, we don't have any other thing coming to NCI. So that will give us how much? 49,000. Then we can then move to note 10, consolidated retained earnings. So consolidated retained earnings, we will have CARS retained earnings. Please, if you have any question, don't hesitate to call my attention.
Yes, sir, please, I do.
189,000. On which one?
I was trying to assimilate this impairment thing. It's not sticking.
We'll have to get maybe a sticky note.
Please, can you just talk about
Hello?
it a bit?
Talk about it again, Ken. The Bible says it has been written for man to die once. After that is what? Impairment. They have said that when the subsidiary or when our investment in the subsidiary is impaired, the parent loss will be borne by the parent company only if NCI is measured as proportionate here. Because when NCI is measured as proportionate here, NCI does not have goodwill. So if it doesn't have goodwill, there's no way it can suffer impairment. But where NCI is measured at fair value, then that means NCI will have goodwill. If it has goodwill, it will definitely share part of the impairment loss suffered. And since in this question, NCR is measured at market value, that is why we are sharing the impairment. Does it make sense?
Yes, thank you.
You're welcome. So having shared this thing, we check our adjustments. Unrealized profit on inventory 16 on over depreciation 500. Unrealized profit on inventory. Over depreciation. Okay. So over depreciation is supposed to be 8. Over depreciation is 500, and I think that's all. What do we have as the submission, please?
$187,450.
Okay, so we have consolidated statements. So consolidated statement of financial position as at 30 November 2007. We'll have what? Oh, it's even dollar. I hope I have not been working with Naira since. Non-current assets, we have PPE, which is 138,000 plus 115,000 minus what? The unrealized profit of 5,000. Then we add the over depreciation of 500 back. What do we have? Investments.
248,500.
We have what? 98,000.
248,500.
248,500. So for investment, we have 98,000. We'll take out the investment in the subsidiary, 76,000, and the intergroup loan of 20,000. That will give us what? 2,000. So that 2,000 would have represent their other investments. Then we have goodwill, 21,250. So current assets, we have what? Inventory, which is 15,000 plus 17,000. Well, we take out the unrealized profit on inventory of 16. Then receivables, we have what? 19,000 plus 20,000. And we have what? From our adjustment, we are crediting receivables with 25 and 15. Let me show you again. 25 minus 15. I'm sure you see again. I'm sure you see the country principal. So we have what? For cash, we have 2,000 plus the cash in transit that we have here. I would say we should debit here 25. So please give me the figures.
For
Please, if
inventory,
you have any,
3,400.
okay, inventory 3,400. If you have any question, feel free to ask. If you want me to re-explain anything, let me know.
Receivable, 35,000.
35,000.
And
This
cash
should
for
be 4,500. Summation, please. For the equity, we have share capital 50,000.
6,900.
Huh?
69. Okay.
Consolidated retained earnings
That is 341,150.
341,150. So our consolidated retained earnings was 187,450. So this will be 237,450. Then NCI 49,700. Then we have non-current liability 8% loan notes 20,000. We say we have to recognize that, so it will become nil. Then current liabilities 33,000 plus 23,000 minus what are the adjustments we have to current liabilities? We are debiting payables with 1.5, and I think that's the only one. Debit payables with 1.5.
Yeah, I'm
If we
getting
debit this with 1.5, what do we have left? What do we have left?
54,500. 54,500.
54,500. So with that, what's the summation, please?
It's 341,650. 650, not 150.
Which one? You mean the assets?
The total, 341,650.
Is that for the liability or for the assets?
The asset and the liability.
Okay. So, any question on this before we call it a time? Any question?
No, sir.
Okay, ladies and gentlemen, let's start to take our time to go over all of this discussion again.